The real estate market has a big problem these days with a lack of inventory of homes for sale. This has a lot to do with the fact that so many homeowners feel trapped by their current mortgage rates that even if they want to move, they just don't want to give up that low interest rate. So what are you supposed to do if you feel trapped by your low mortgage rate, but you are ready to purchase a new home? One option is that you could actually turn your current primary home into a rental property and then purchase a new primary residence. This would allow you as the homeowner to hold on to that low mortgage rate and maybe even make a little bit of extra cash flow from the rental and still purchase a new primary home. Now, a lot of people think when you're purchasing a new home that you need 20% or more down, but anytime you're purchasing a primary residence, you still have many low down payment options available. Now, there are different rules for different loan types, and it's very specific on what they require. So I just wanted to go through those guidelines with you real quickly. As always, if you're interested in purchasing a home, I'd love to help you out with that process. You could feel free to contact me anytime or reach out to me through my website. Now let's just go through the guidelines quickly, as there are very different rules for each different type of mortgage loan. First, let's just cover the basics. So if you're planning to rent out your current home, during the loan process, you're actually going to need to seek out a tenant and provide an executed lease agreement to the bank. Now, the way that this works is, let's say that that lease agreement is for $3,000 a month. The bank is going to take that times 75%, which in this example is $2,250 a month. Now, if your current mortgage payment is $2,250 a month, then it's a wash, and that's not going to count against you for your DTI. You just need to, of course, qualify for the new property that you're looking to buy. Conventional loans are actually the easiest with this specific rule. Now, if you're doing a Fannie Mae loan, all you need to do is provide that lease agreement that we just mentioned. And if you have positive cash flow, that would also add to your income. What I mean by that is, let's say that in that example, you got $2,250 a month in rental income and your mortgage is only $2,000 a month, then that would actually add $250 a month to your cash flow. Now, the rule for Freddie Mac is different in two ways. The first is that you need to provide the lease agreement, but also prove that you've received your first month's rent plus a security deposit. The second difference is that you cannot actually add positive rental income to the cash flow. The rent can only be used to wash away the other mortgage. Now, the FHA and the VA do follow the same guidelines that I just described for Freddie Mac, with one very big difference. If the home is 100 miles away or more, then you're fine. However, most people are looking to move within a close proximity to where they live now. Now, if it is less than 100 miles, most banks will not allow you to use the rental income from your vacating primary home. However, there are some conditions that you can do this. The first is that you would have to get an appraisal on your current home and make sure that you have at least 25% equity in the property. Now, the other difference is that the only way the bank will accept the rent on the vacating primary home is if you actually have a management company rent out your property. Now, you'll also have to take into account the management fee for renting out the property. Those are the basics on how you can actually rent out your current primary home and purchase a new primary. As I mentioned earlier, you're always welcome to give me a call or contact me through my website, and I'd love to help you on your journey to homeownership.